Life insurance as strategic. Wealth architecture. Slide 1. You've built the estate. Is it built to last? You've built something substantial. Assets, businesses, investments, a legacy in motion. But wealth is not measured by what you accumulate. It's measured by what survives you.
This question is not emotional. It's architectural. Is your estate designed to endure taxes, transitions, and time itself?
An estate is everything you own and control at death. Estate durability means having liquidity and structure, so your wealth is transferred, not dismantled.
Beyond income replacement.
Life insurance as a master toolkit.
For most people, life insurance replaces income. For the affluent, its purpose fundamentally changes.
When structured correctly, life insurance becomes a financial toolkit. One tool solving many problems: taxes, liquidity, succession, and legacy.
A life insurance death benefit is money paid to beneficiaries, generally income tax-free and, when properly owned, state tax efficient.
The fortress, estate, and legacy preservation.
Every strong structure begins with defense, before growth, before legacy. Your wealth must be protected from erosion.
This pillar focuses on 4 risks that silently destroy estates: taxes, inequality, time, and special needs vulnerability.
Preservation means ensuring assets transfer intact, without forced sales, family conflict, or tax shock.
Federal estate taxes can claim up to 40% of assets above the exemption. That tax is due in cash immediately.
Without liquidity, families are forced to sell businesses, real estate, or investments, often at the worst time.
Estate liquidity means having immediate cash to pay taxes.
Life insurance provides tax-free liquidity exactly when death creates the tax bill.
Equalizing wealth among heirs.
Illiquid assets, like businesses, cannot be divided evenly.
Life insurance creates cash equality where assets cannot be split, preserving both fairness and family harmony.
Wealth equalization using insurance proceeds to balance inheritances without breaking the business.
Each generation faces erosion, taxes, expenses, poor stewardship. Placed inside a dynasty trust, life insurance creates a protected river of capital flowing to children, grandchildren, and beyond.
A dynasty trust keeps assets outside taxable estates for multiple generations, bypassing estate tax repeatedly.
Funding lifelong care for special needs.
Special needs care requires certainty, not hope.
Insurance funds a special needs trust, providing lifelong support without disqualifying government benefits.
A special needs trust holds assets for care while preserving eligibility for Medicaid and SSI.
The engine tax-advantaged growth in income.
After protection comes efficiency.
Certain insurance policies function as private tax-advantaged accumulation engines, beyond traditional retirement limits.
Permanent life insurance can build cash value that grows tax-deferred and is accessed tax-free through policy loans.
Tax-advantaged wealth accumulation.
401s and IRAs have limits.
Life insurance does not.
Capital inside the policy grows without annual taxation and can be accessed without triggering income tax.
Policy loans are not income.
They allow tax-free access while the policy remains intact.
Choosing a joint and survivor pension protects a spouse, but reduces income.
Instead, insurance replaces the survivor benefit, allowing higher lifetime income and spousal protection.
Pension maximization trades pension reduction for insurance-funded certainty.
Tax-free retirement income.
Every dollar from traditional retirement accounts is taxable.
Insurance cash value creates a tax-free income stream, preserving budgeting power.
Tax-free income means withdrawals via loans not reported as taxable income.
The blueprint, strategic asset and business design.
Some challenges demand precision.
Not general planning.
This pillar addresses succession, protection,
and purpose. Illiquid assets like businesses cannot be divided evenly.
Death without funding destroys businesses.
Life insurance funds buy-sell agreements, ensuring smooth, immediate ownership transfer.
A buy-sell agreement is a legally binding plan funded with insurance to prevent chaos at death.
Creditor protection.
Wealth attracts lawsuits.
In many states, insurance values, especially in trust, are shielded from creditors.
Creditor protection means assets are legally unreachable in lawsuits.
You can give more than you ever saved.
Insurance multiplies charitable impact, turning premiums into amplified tax-free gifts.
Charitable leveraging uses insurance to create outsized philanthropic impact.
This is not a product.
It is a system, a financial chassis engineered for preservation, growth, and meaning.
Is your plan using every tool available?
A good plan accumulates wealth.
A great plan protects it, transfers it, and gives it purpose.
Together, the sea is not accidental. It is design. Together is your plan using every tool available.